All right, let's get started. Today, we're going to dig into a concept that's kind of a secret code in accounting. It's the real reason why some companies that look profitable on paper can suddenly go bankrupt. It's called outstanding expenses. And by the end of this, you'll be able to spot financial red flags that most people totally miss. So let's kick things off with a real head scratcher. Can a company that's making a profit actually go broke? I know, it sounds like a trick question, right? But the answer is a huge, resounding yes. And this isn't some academic theory, it's a very real trap that has caught so many businesses off guard. And the reason that's possible comes down to one simple but super important idea. Profit is not the same thing as cash in the bank. You can have a company that looks fantastic in its reports, but has absolutely no money to pay its bills when they come due. So today, we're going to untangle this whole mess by focusing on one key idea. Those expenses you owe, but you just haven't paid yet. So here's our game plan. We'll start by cracking that profitability puzzle. Then we'll get a really clear definition of what outstanding expenses actually are. We'll see how they work in practice, look at some common mistakes people make, and finally, learn how to read between the lines of a financial statement. All right, let's tackle that profitability puzzle head on. You see, the secret isn't just about what a company earns or spends. It's really all about when those things get recorded. In the world of accounting, believe me, timing is everything. You see, there are really two main ways to look at a company's books. On one hand, you've got cash accounting. It's super simple. When cash comes in, you write it down. When cash goes out, you write it down. But that can give you a really skewed view of what's happening. On the other hand, you have accrual accounting, and this is the system that basically all modern businesses run on. With this method, you record revenue the moment you earn it, and you record expenses the moment you incur them, which can be way before any money actually moves. This gives you the true story of a company's financial health. So, what's the big rule that makes accrual accounting work? Well, it all comes down to something called the matching principle. This is the bedrock logic of it all. It says you have to match your expenses to the revenues they helped create in the very same time period. So, for example, if your sales team lands a massive deal in December, their commission is a December expense. It doesn't matter if you don't actually pay them until January. This principle is what prevents a company's books from looking wildly profitable one month and then crashing the next. Okay, that makes sense, right? But how do you actually record an expense you haven't even gotten a bill for yet? Well, accountants have a specific tool for this, and that tool is called outstanding expenses. Just think of them as debts that are already on your tab, even if the official invoice hasn't landed in your inbox. So here's a formal definition. An outstanding expense is a cost that a business has already benefited from in one period, but the actual payment for it isn't going to happen until a later period. The best way to think about it is like using your credit card. The second you swipe that card, you owe the money, right? The expense has happened. You don't wait until you get the bill next month to admit you have that debt. It exists right away. It's the exact same idea here. And trust me, these are everywhere in business. I mean, think about employee salaries. If the month ends on a Wednesday, the company owes its employees from Monday, Tuesday, and Wednesday, but that money won't be paid out until the next payday. That's a classic outstanding expense. Same goes for the electricity you used all of December. You get the benefit now, but the bill comes in January. All of these are perfect examples. Okay, so we've got the what and the why down. Now for the how. Let's roll up our sleeves and see how accountants actually take this concept and make it work on the company's books. It's actually a really clever two-step dance. First, at the very end of the month, the accountant makes what's called an adjusting entry. They officially record the wage expense for that period, and at the exact same time, they create a liability, a debt, called outstanding wages. That puts the debt on the books. Then, in the next period, when they actually pay the employees, they make a settlement entry. This second step wipes out that liability and shows the cash finally leaving the bank account. It's a perfect system that keeps everything balanced and accurate. Now, this is where a lot of people get tripped up, and it's a super common area for mistakes. It's crucial to understand that in accounting, not all debts are created equal. So let's clear up some of that confusion right now. This table really breaks it all down perfectly. Let's walk through it. First, look at that top row, under status. Our outstanding expense is something you've incurred, but there's no bill for it yet, like those end-of-month wages. Now, shift over to accounts payable. This is different. Here, you have an official invoice in your hand. You just haven't paid it yet. And then you've got prepaid expenses, which is the total opposite. This is when you've paid for something you haven't even used yet, like an annual insurance policy. And notice that crucial difference on the balance sheet?
The first two are liabilities, money you owe, but the last one is an asset, something of value you now own. It really all boils down to timing and paperwork. Okay, this is where we zoom out from the nitty-gritty accounting and get into the big picture strategy. We're moving beyond just bookkeeping and into real financial intelligence. Why should any of this matter to you as an investor, a manager, or just someone trying to figure out if a company is truly healthy? The reason this is so important is because outstanding expenses are a huge piece of something called working capital. And you can really think of working capital as the lifeblood of a company. It's the money it needs to survive day to day. So these unpaid bills have a direct impact on that survival fund, making them a really critical vital sign for a company's health. And we have a great tool to measure this. It's called the current ratio. It's pretty simple. You just take a company's current assets, like its cash, and divide them by its current liabilities, which of course includes our outstanding expenses. Now, if that number dips below 1, like the 0.9 you see here, that can be a big warning sign. It's telling you that the company might not have enough cash on hand to cover all of its short-term bills. So what's the bottom line here? Well, analyzing outstanding expenses gives you some incredible insights. It helps you see the true quality of a company's profit. Is it real profit, or is it just inflated because they're not recording their bills properly? It also tells you a ton about how well that company is managing its cash. A growing pile of outstanding expenses could be a smart move, using suppliers' money as a free loan. Or it could be a major red flag that they're about to run out of cash. Ultimately, understanding this stuff is what allows you to actually trust the financial reports you're reading. And really, that leads us to the most important takeaway of all. Real financial intelligence isn't just about counting the cash in the bank account. It's about seeing the full picture, especially the debts and obligations that are hiding in plain sight. Mastering concepts like outstanding expenses is what truly separates basic bookkeeping from deep financial wisdom. It's how you learn to read the real story a company's numbers are telling you.